and thank you for joining our fourth quarter market outlook. My name is TJ Kistner. I am the Chief Investment Officer at Retirement Plan Advisors. Today, I'll go through market performance across the 2023 calendar year and also discuss our forward-looking views across asset classes. We hope you find the discussion helpful and informative. 2023 will go down as one of the strongest, if not most confounding bull markets in recent memory. Coming off a year in 2022 in which stocks dropped around 20% in an environment of still high inflation and a Federal Reserve that continued to signal higher interest rates, many investors were uncomfortable putting money to work in stocks. Despite this, many economists were surprised as inflation steadily declined in 2023, growth remained robust, and consumer spending was supported by wage gains and increasing home prices. The most highly anticipated recession in decades never came, and stocks ended the year up 26%. Interestingly, earnings didn't grow at all over the course of the year, which means the entire 26% gain in the S&P 500 was attributed to price-to-earnings multiples expanding, or said differently, valuations got richer. As you can see in the chart, almost half the year's gains in equity markets came in the fourth quarter alone. In October, the interest rate on the 10-year U.S. Treasury hit an intraday high of over 5%, on fears that the Federal Reserve would have to keep rates higher for longer in anticipation of continued strength in the U.S. economy. This caused stock and bond prices to fall through the end of the month. However, in early November, the Fed signaled that the rapid rise in the 10-year Treasury yield could actually act as a rate hike, and the market took this to mean that the Fed was done increasing interest rates, which sparked a significant rally across virtually all markets. And in this chart, we illustrate the dramatic decline in interest rates. As you can see on October 19th, the 10-year U.S. Treasury yield touched 5%. Less than a month and a half later, it had declined 110 basis points, or 1.1%, boosting virtually every market around the world. Turning to our forward-looking views, the Fed's pivot is undoubtedly a strong signal to the market. This part of the cycle has typically coincided with strong stock and bond returns as the Fed moves away from trying to slow growth, which is exactly what we saw in the fourth quarter. But the strong rally in the fourth quarter has priced a lot of this in, and we are left once again in an environment of high equity valuations, optimistic earnings growth expectations, and very tight credit spreads. Despite this, we don't see a lot of concern in the immediate term from an economic standpoint, which causes us to be neutral across equities and credit. Now, that's not to say we think the economy is completely in the clear and it's time to load up on risk. In fact, we do have some concerns that the full impact of the Fed's tightening cycle has not yet made its way through the economy, and we could run into some issues later in the year. That's one of the reasons we like treasuries in the current environment, along with still high interest rates and yields. And given the possibility of falling interest rates as the Fed cuts, we do think now is a good time to put cash to work, even if in very low risk, short duration fixed income. Switching to global asset classes, our views across equity markets remain unchanged from the prior quarter. But as the Fed begins cutting interest rates, we would expect the dollar to weaken some. This could actually prove to be a tailwind for areas outside the US, such as Europe, Japan, and even emerging markets. In addition, we would expect any strength in the US stock market to be across a much broader basket of stocks, certainly relative to what we saw last year. And in this environment, areas such as small caps and even value stocks could perform well. We did make a few changes to our views within fixed income. I mentioned earlier that credit spreads remain tight, which historically is not a strong buy signal. However, interest rates remain high, and if credit conditions remain relatively benign, areas of the market such as high yield, bank loans, and even emerging market debt could be attractive. Obviously, this assumes defaults remain low and credit spreads don't blow out. But absent a dramatic economic or geopolitical event, we think these areas of the market could do well. Thank you for listening. We hope you found the information helpful, and we want to wish you all a very happy and healthy new year. And remember, the future is better than you think.